Good morning, dear friends. It's Monday, September the 8th, 2025. My name is Clive Thompson. I'm here to give you a summary of everything which is going on in the world of finance, investment and the economy. Today I'm covering Friday through to this Monday morning. It's nearly midday today. Let's start with Friday. The big news, or should I say the bad news, was the payroll, the non-farm payrolls report or the jobs report. This labour report is closely watched globally as it's a bellwether of how well the US economy is doing. It's produced by the US Bureau of Labour Statistics, or the BLS, and it measures the number of people employed by companies excluding farm workers. Now, due to net immigration into the United States, the number should be rising by well over 100,000 jobs a month. But the last 3 months have been well below that number, indicating a slowing economy. The official numbers, and I'm going to tell you I don't believe them, but the official numbers showed that new jobs were, over the last 3 months, were 75,000, 35,000, and in August, 22,000. That's all three are disappointing numbers, but the August one is a terrible number. These are bad numbers because they indicate that the economy is slowing and maybe going into the first recession since COVID. Now, those numbers are actually worse than they look. When announcing the non-farm payroll, the official number is and has been consistently too high. The official number always looks better than it really is, and after the event, in a month's time or 2 months' time, they tend to revise that number down. The way they improve the month's number, the current month's number, is to revise downwards the previous numbers. So by revising down last month's number and the month before's number, they can make the current number look better than it really is. And this happens almost every month. So when they announced that just on Friday that the August number is 22,000 new jobs, which is a terrible number, it's way too low, it's way below what the market was expecting, that's actually a massive overstatement, because had they not revised the previous 2 months down by 53,000 between the 2 months of June and July, the number of new jobs would have been negative, not positive. So in plain English, we have a slowing economy, and we're maybe heading into recession. Now, perhaps the question you're asking is, how come the US stock markets are ignoring all this? I mean, last Friday, although they finished very slightly below, they brushed the all-time highs. Now, the reason the stock market hasn't crashed on this news of terrible labour results and going into recession and so forth is that the stock market is forward-looking. It now sees a virtual 100% probability that interest rates will be lowered on September the 17th. Lowered because the employment numbers were so bad. So if interest rates are lowered, it will lead to higher inflationary expectations and lead possibly to a steepening of the yield curve. Now, what's a steepening of the yield curve? It means that the short-term rates set by the Federal Reserve might be going down, they're lower, and they're lower than the longer-term rates, which are not set by the Federal Reserve, they're set by the markets, by you and I buying and selling bonds. So even though we might get, and we almost certainly will get on September the 17th, an announcement that the federal funds rate is coming down by probably 0.25%, traders might sell the longer dated bonds, lowering their prices and thus increasing the yield. That would be a steepening of the yield curve. So let's go on. I'm getting to the point why this is good for the stock market, because again, higher yields would seem to be bad for the stock market at first sight. But in this particular case, in this situation, the higher yields will mean that it becomes more costly for the US government to borrow money, at least if they're borrowing longer duration bonds, issuing 10-year or 30-year bonds. Now, because the US government's already in a debt crisis, it's deep dodo with far too much debt it can't handle, high interest rates are a problem, because the interest rates and the interest payments on the government debt, the amount they borrowed previously, is already consuming a huge percentage of what the government collects in taxes. And every year, for the last few years, it's been consuming more and more of that government tax take. And according to the Congressional Budget Office, the CBO in America, that's the government body, these figures are only going to get worse. And that's, according to their numbers, assuming no rise in borrowing costs. And I'm telling you, it's possible that borrowing costs will actually rise here. So, based on their own numbers, the debt and interest payments are set to spiral out of control at some point. We can't say when it spirals out of control. It spirals out of control when suddenly confidence is lost and everyone says, I'm not buying any more government bonds. But it's not a question of if, it's a question of when. And how long can we keep kicking the can down the road? And I think that can happen for a long time. So let me just walk you through this story as to why it's going to be good for the stock market at the end of the day, because that's a bit puzzling for many people. So if we go into a recession, the tax take will fall, and potentially the borrowing cost on longer dated bonds will rise. So on inflationary expectations. So this will only accelerate the fateful day when everything goes wrong. Now, to stop that happening, it's likely that the Federal Reserve will step in to buy longer dated bonds. They'll be buying the bonds that nobody else wants. They'll be buying the bonds where the government wants to borrow money, but nobody wants to lend the government money. So the Federal Reserve steps in as lender of the last resort to the government, effectively, in this case, not to the banks. So as they do this, they're buying the bonds, supporting the prices or even raising the prices, and as the price is supported or raised, it stops the yields from rising, and the yields can go down if they buy them and push the price up. So this is called yield curve control, YCC. And it's what the Federal Reserve did in the 2008 financial crisis, the global financial crisis, and it's what they did again in the COVID pandemic. And they did it with some degree of impunity on inflation. So if we get into a government crisis where people don't want to buy the government bonds or lend money to the government, it's likely the Fed will step in again and do the same thing. But here's the crux. Where does the Federal Reserve get the money from that it needs to buy all those bonds? Well, this is what's going to drive the market higher. The answer is simple. It rolls the printing presses even faster. They print more and more money, which is used to buy the government bonds. So the money they issue or the money they print is the liability side of their balance sheet, and the bonds they buy is the asset side of the balance sheet. So they roll the printing presses faster and faster, buy all these government bonds, their liabilities get bigger, their assets get bigger, and the size of the Fed's balance sheet will grow. That's what I think will happen down the line, and that's what the forward-looking stock market is actually seeing. It sees this wall of money, which it might take 6 months or a year before it starts, maybe a year and a half, but it sees this wall of money is going to be coming to Wall Street at some point looking for a home. And walls of money need to find a home. They're not going to stay in cash in an environment which is perceived to be potentially going inflationary. So that wall of money is going to enter things like equities and gold. Obviously, gold will be a major beneficiary of this, both with the inflationary expectations and the need to park money in something where they feel they have more certainty than dollars in the bank. So, obviously gold could rise as well with this. So when we have a lot of money being printed, people are less inclined to keep that money or their spare money as savings. They prefer to put it into other investments which will hold their own and protect themselves against inflation. So it's hardly surprising that on Friday we saw that gold hit an all-time record. And let's just take a look at that gold price now. I'm just going to bring it up for you. Where is it? commodities. Looking for it on my screen. Let me bring my screen up anyway. And there we are. Let's go to gold. Here we are. Gold, dollars. Oh my goodness, it was an all-time record at 3,550 a couple of days ago, Friday rather. It's up $25, it says today, a bit more than yesterday's open. So, yeah, $3,611. Gold is over $3,600 for the first time ever. The previous all-time record looks like it was 3,580 a couple of days ago. But, it was, if we look here, it was closing at... what was it, about 3,540. So it looks like it's up about $70 since most of Friday. And while we're on it, let's look at the silver price. Goodness me, that's over $41 again. It did have a few forays over $41 in the last few days, but it's here on the 3rd and then again on the 5th, but it didn't quite hold that $41. It's now over $41 again. Let's see if it can hold there. So I was going to tell you that silver's over $40 an ounce, but it's over $41 now. Now, while we're on gold and silver, which both look like they got money going into them, I'd just like to remind you that I have 2 affiliate links down below. One is for Gold Bullion Partners in the UK and for European buyers as well. And the other one is for ITM Trading in the USA. So if you want to buy a lot of gold, these are great people to buy from, and they've got the telephone number of each company is below this video. You can see it, and there's also a link to their website if you want to look there. So you can call them up if you want to buy a lot of gold. Now let's move on to Europe and what's going on in France, because we have a bit of a problem in France this morning. So France is in a political crisis over its tough budget plan. It's a tough budget plan because it freezes the government spending, increases taxes on pensioners, reduces the number of bank holidays and things like that. And it needs a tough budget plan because its debt is very high. It's 110% of GDP. It's one of the highest debt to GDP ratios in Europe. And the reason it's got such a high debt to GDP ratio is, like so many other countries, like the UK, like America, like Japan, each year France spends more money than it collects in taxes. And so last year the budget deficit was about 5.5% of GDP, which is well above the maximum target proposed by the EU, which was you shouldn't have a budget deficit, if you have one at all, of more than 3% of GDP. So they're way out of line there, and they should do something about it. And of course the ECB wants them to do something as well. That's kind of what the ECB is there for, to encourage the governments of each country to be strong and not run deficits which are too high. But the France's deficit is too high, and that's why they got this strong budget. But this is causing a political crisis. So, I mean, one of the problems they're going to try and solve with this budget is the ballooning interest on debt. So just to illustrate this, how bad the problem is, it's spending over $50 billion a year on interest. So put that in perspective, they're spending more on paying the interest on what they owe than they're spending on schools, or more than they're spending on defense. And this is the same problem that we're facing in the USA, UK, Japan, and probably several other countries too. So unfortunately for the Prime Minister, whose name is Francois Bayrou, his Mouvement Démocrate party, along with its allies, which include President Emmanuel Macron's Renaissance Party and the other allies, will not be enough to outnumber the opposition parties, which include the Rassemblement National, led by Marine Le Pen, and various other left-wing parties, and the party called Les Républicains, led by Eric Ciotti. I don't know if that's how, I know it's pronounced Ciotti or Ciotti, but Ciottti. So today, France is going to have a vote of confidence or no confidence. And the question which will be asked to the National Assembly, which is the Parliament of France, is, does the National Assembly have confidence in Bayrou's, the Prime Minister, government, does he have confidence in Bayrou's government to proceed with the 2026 budget reforms? So, a vote of confidence or a vote of no confidence? If he loses the vote, it will throw France into chaos, and possibly the whole of the Eurozone, because it will mean that the austerity measures which are being proposed, like increasing taxes on pensioners, cutting public holidays, freezing almost all government spending, all those proposals will be gone, and France will probably have some other budget which will not nearly be as austere. So if that happens, I imagine that French government bonds will fall in price, and we'll just they're not that expensive at the moment, but let's just have a quick look at French government bonds now. Let me bring that up, and we'll go to here we are, France 30-year bonds. So 30-year bonds, it's at 4.38%. It's not far off the maximum perhaps a week or two ago, but it is a very high rate. But if we compare that with the German 30-year bond, so France at 4.3738, Germany at 1%, more than 1% lower, at 3.29%. And if we look at the 10-year German, it's at 2.67%, and the 10-year France at 3.44. So France's bonds are yielding, even though the currency is the same, it's euros, Germany uses euros, France uses euros, the yield on the bonds is significantly different. And what's that reflecting? It's reflecting the fact that bond investors, they're being bond vigilantes, but they're telling us that they have doubts about whether the euro will still exist some years from now, certainly 30 years from now, because of the huge difference in interest rates between Germany and France. And they're wondering, will France ever repay, or will they ever be able to repay their debts? That's kind of where the difference in yield, what the difference in yields is showing us. So what else is going on? Well, China has said its exports have slowed, hardly surprising because of the exports going to the United States is going down. So the People's Bank of China, the PBOC, has injected liquidity in the market to try and support government bonds, support equities, shore up housing, and that sort of thing. This morning in Europe, the European stock markets are not all, but mostly starting to rise. So we go to look at the indices here. Just go here. The stocks. Yeah, here we are. So we look at the CAC 40. Despite the political turmoil in France, it's up a little bit this morning, up 0.25%. Germany up more than 0.5%. And if we run the Euro stocks down 0.25%, the FTSE 100 down ever so slightly at 9218, barely changed. We see that Asia was up. Hang Seng Index was up nearly 1%, and that's obviously thanks to the liquidity coming to the market from the People's Bank of China. And the Nikkei Index is up quite a nice percentage. It looks like 1.93%, not bad. And you can see that's rising strongly in the. Let's put that to a 1 month chart. No, that doesn't work. Let's go like that and auto fit. So there you go. You can see the Nikkei index has risen quite sharply in the last few days. And looking at the China index, that's not far off the recent highs. And the Nikkei pretty much at the highs recently. And just looking at the Dow Jones and the S&P last night. Dow slightly down last night, but still pretty close to the all-time high. Now, what else have we got going on today? Yes. On Wall Street, we saw Broadcom rise sharply. I haven't got that one on my screen. I can't show you that one immediately. And Robinhood, here we are. Robinhood rose sharply. I'll put that into just the 5-day mode so you can see the So the white area, the light grey area is post-market. The white area is pre-market this morning. So you can see Robinhood, which closed at 101.25, is now trading in the pre-market at 108.83. So it's up about 7% on the news that Robinhood is going to join the S&P 500. Elsewhere, Stephen Moran has been confirmed as the replacement for the Federal Reserve Governor Adriana Kugler. She resigned abruptly a week or two ago, 6 months before her term was up. Now, Stephen Moran, who's going to be the new Federal Reserve Governor, he's currently the chair of the White House Council of Economic Advisors. And strangely enough, he's not going to resign from that role, although he says he'll take a holiday from it, but unpaid holiday presumably. But if he's not resigning from that government position of chair of the White House Council of Economic Advisors, isn't there a conflict of interest with him being on the Federal Reserve, which is supposed to be independent? Well, anyway, that's what he says. He won't resign from that government position, but he'll be on the board, one of the governors of the Federal Reserve. Meanwhile, we also have Lisa Cook, who's been fired from the Federal Reserve by President Trump. She's arguing that out in court, saying that Donald Trump has no authority to fire her. So until the courts rule otherwise, she will be able to attend the next FOMC meeting, which is on September the 16th and 17th, with the announcement about interest rates on the 17th. Now, while on the subject of gold a little bit earlier, I forgot to mention that I've got a video coming out which will be giving you the heads up on something I've stumbled across by accident. And this is important if you're interested in gold mining shares. A major investor is about to invest billions into the shares of a very small group of quoted gold mining companies. And I do mean billions, not millions. Now, this information is potentially available to you if you're an internet sleuth, but it's hard to find. And it's just not been reported by any other YouTuber or by any news outlet as far as I can tell. So I'll probably, when I bring this video out, I'm working on it as fast as I possibly can. I'll probably be the first to tell you all about it. You probably won't find it with a Google search, but even if you do, it will be very difficult for you to discover which gold mining shares are going to be bought. But I've spent all day Sunday digging deeper and deeper to find that out. Now, these purchases will probably not be made this week. They'll probably be made next week by this investor. And in my upcoming video, which might come out later today, more likely tomorrow, but I can't say for sure, I will name the investor. I will name the specific gold mining stocks which will be bought, and I will say how many hundreds of millions he or they or she, depending on what I'm going to tell you. I'm going to tell you how many hundreds of millions will be invested into each one of these gold mining stocks. Now, this is not inside information. It can be found out, but it's very, very difficult to find out. And I don't really think they want you to know what their plans are, but since the information is out there and potentially is available, I'll give you full information as to who's buying, what they're buying, and how much they're investing into each one, and I'll show you exactly how you can check each bit of information yourself, where to find it. It's on the internet, but I've done all the hard work for you. So if you want to be the first to know the names of these gold mining companies, click the subscribe button below and hit the bell button for the notification. That way you'll be notified as soon as that video comes out, and you can be an early on to know. Now, that's not investment advice. That's just me saying it's maybe useful for you to know what's going to change in terms of buying in the gold mining market if you're interested in that arena. Now, ladies and gentlemen, thank you very much for listening and watching. You can like, subscribe, hit the bell, and if you hit the bell, you'll be notified about my upcoming video on the gold mining stocks.